Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
So I think our attendance is a bit less than before the break. So I think I'll send a message via the Wattle Forum to encourage people to attend lectures. And, you know, only in lectures do I give you guidance, specific guidance about what may or may not be examined, and it won't be repeated. Okay. And also, I never mind if people come a bit late or if they have to leave early. That is completely fine. It's better for you to come to some part of the lecture. All right, so now let me get the lights to the appropriate setting. So if you're a person that likes light, move to a chair that has a light over it. Okay, let's go to medium. Okay, good. So what we were up to before the break was, well, we didn't quite finish deductions, the deduction slides, and we were talking about repairs, right? So we discussed in general terms, when can you claim a tax deduction for a repair? And if you were, probably most of you were at that lecture, if we didn't have a specific deduction provision in Section 2510, do you think we would be able to still claim a deduction under Division 8, the general deduction provision, in relation to expenses on repairing property used to generate assessable income? For instance, really the very common example is a rental property. What do you think? Yes or no? Or if we didn't have Section 2510 in the 97 Act, would we be able to deduct, say as a landlord, say you repair part of the ceiling, or say the tenant damages the floor, you repair that, would that be deductible under the general deduction provision if we didn't have this provision? Pire? Yes, it would be, right? So I saw Pire nodding. Yes. So sometimes these specific deduction provisions, sometimes they give us a deduction in circumstances where we wouldn't be able to claim under the general deduction provision. But sometimes it's a case of, well, we would have been able to deduct anyway, and there the purpose of having a specific provision, I suppose, is for the legislature, the government, to clearly set out the circumstances in which a repair deduction is available, but even despite that we have this specific provision, there's still quite a lot of case law that we need to understand as well, although this particular provision isn't difficult, I think. So now, with this particular slide, what we're looking at is distinguishing deductible repair expense from expenses which are capital in nature. And if it's capital in nature, if our expenditure on a property is capital in nature, is it deductible? No, but it's really qualified in this sense. By no, what we mean is, well, not all in one go, but often you can get a deduction in relation to capital expenditure if it's related to the generation of assessable income or for business purposes, but over time, right, under the capital allowances regime, not all in one go. So let's distinguish these situations where the taxpayer thinks this could be a deductible repair, but in fact the law will treat it as a capital expenditure. So if we're looking at expenses that are incurred to remedy or to fix defects that existed at the time of acquisition of a property, right? In order to get that property into a workable state, in order to generate assessable income, in order to operate your business there, then that is not going to be deductible, right? So Thomas's case is authority for that. So what happened in that case was you had a flour miller, right? So that's used for, flour's used for, making bread and other bakery products. The flour miller purchased a dilapidated building. That is, it was not in a good working condition and not suitable for their business purpose yet, and they made renovations to that building. Right. Now, the renovation expenditure, in order to get the building into a workable state so that he could operate his business, that is not deductible, right? It is capital in nature. And actually, if we hear about renovations, right, renovations are to increase capital value. So the only thing you could hope for there is some relief under the capital allowances regime. Okay, a second situation that arises commonly in the context of repairs and knowing when they're deductible or not is, well, distinguishing deductible repairs from improvements. If the effect of an expenditure on property is to functionally improve the property or an aspect of it, so that it is better than it ever was before, even at the start, then it's not going to be a deductible repair expense. It'll be capital in nature. So a good illustration is FCT and Western Suburbs Cinema. So here you had a cinema operator, right? That was the taxpayer. And this cinema operator was denied a tax deduction in circumstances where they replaced the ceiling of the cinema. They replaced it with a better material, right? It was previously a material called Celotex, and it was replaced with Fibro. That was considered a superior material according to expert evidence, and no deduction was allowed, right? Now, with respect to a ceiling, it is the case that, and various other parts of a property, that they will not, last forever. Well, even buildings don't last forever. And there's, as a result of reasonable wear and tear, you do need to, from time to time, it could be many years, eventually replace ceilings, right? So with a ceiling, it's not a separately identifiable asset, right? So that's what we'll talk about next. It's not a separately identifiable asset. It's part of the building. So that if the taxpayer in the cinema case, if they use the same kind of material to replace the ceiling, right, Celotex, then they would have been able to get a deduction, right? Okay. Now, then the next type of case is where the expenditure actually involves replacement of a separately identifiable asset. That is capital expenditure. That's not a deduction. Now, how do you know if you're dealing with a separately identifiable asset? Well, you ask the question, what you're dealing with, is it really part of something else? Or is it functional? Does it have a purpose all on its own? So with something like a desk, right, it's a separately identifiable asset, right? It has a function or a purpose. So if you replace a desk, it's replacement of a separately identifiable asset. It's capital expenditure. If you are replacing a chimney, right? It's part of the building. It's not a separately identifiable asset. Sometimes it can be actually tricky to distinguish. So, this case is not the easiest case. In Lindsay, the court held that there was a separately identifiable asset when a ramp to a ship was replaced, right? So now it was demolished and replaced with a new slipway or ramp. The court held it's a separately identifiable asset. Okay, I guess you can, the ramp is something that can be detached from the ship, so in that way you can view it as a separately identifiable asset. But so I suppose it's all right, the reasoning of the court. Another basis, and it's an independent basis, in that case for concluding that it was capital expenditure, is really that it involved an improvement as well, because it was the ramp, when it was replaced, the taxpayer used concrete rather than timber. But even aside from that point, the court held this ramp, it's a separately identifiable asset to the ship. Okay, let's move on. Bad debts. Okay, so this is a specific deduction. It's under Section 2535, right? So you're familiar with bad debts from your accounting studies, no doubt, right? So you recognise a bad debt when, well, you must have sold products on credit and it's been determined that the customer is unlikely to pay. Now, you actually have to write off the debt as bad, right, in an accounting sense, before you can recognise the tax deduction, right? And that's under Section 2535. Tax losses. Now, by tax losses, for the purpose of deductibility, what we're talking about is a prior year tax loss, okay? Now, a prior year tax loss, or it could be several years of prior year tax losses, they are deductible when you start earning income, right? So in the year in which you make the tax loss, you can't do anything with it. It's of no benefit to you because you're in a loss position. You won't have to pay tax because you only pay tax when you have taxable income. But that loss that you made, the benefit that can be realised is in the future. When, now generally, we are talking about businesses nearly always. When the business generates income in the future, it is able to use the prior year loss as a tax deduction to reduce taxable income. Now, the business can be either run by a company or an individual, right? That's not an issue. But to be talking about getting a deduction for a tax loss, generally we are talking about businesses, right? Whether it be a company or an individual. As an individual who is an employee, who is earning salary or wages income, you don't get into a loss position. The issue doesn't arise because it could be sometimes you make very little money. It could be you have very little employment income. In some years, perhaps you don't have any income. But as individuals, unless we're running a business, we don't get into, we may get into debt, but the issue of a tax loss doesn't arise because even if we get into debt, unless there's a business connection somehow, it's not relevant for tax purposes, right? Now, in terms of utilising those prior year tax losses, there's a difference between individuals and corporate taxpayers, companies that is. Now, in order to recognise sort of a tax loss that can be reduced used to reduce taxable income, the legislation states that you first have to use that tax loss to reduce exempt income, right? Exempt income, it may be exempt for tax purposes, but it's still of economic value. Now exempt income may be irrelevant for most people, but for some taxpayers it exists, and so you have to take into account. So if you've got a tax loss, the government's not going to give you the benefit of claiming a deduction if in fact in this income year you've got some exempt income. So first you have to reduce exempt income, and maybe as a result of that process you haven't got a tax loss anymore, right? Okay, now putting that case aside of exempt income, which probably isn't relevant for most taxpayers, right? Then the difference that arises between corporate and individual income taxpayers is that whereas individuals are required by law to utilise any prior year tax losses they have and to reduce their taxable income, right? And it could be more than a reduction, it might actually eliminate taxable income for that year, and there may be still a carry forward loss for the subsequent year. So individuals are required to utilise those tax losses, but companies are not required to. They have the full benefit of those prior year tax losses, but it is up to the company as to whether it utilises that tax loss to any extent. It can simply carry it forward, it can use part of it, it can, decide that it's going to engage in some kind of smoothing process where it will use part of the tax loss over a number of years. It's entitled to have that flexibility under the law. Okay, moving on, tax-related expenses. Section 25(5) gives you a tax deduction for the cost of managing your tax affairs, right? So that's a very useful one to know. People, especially when their arrangements and their income are more complex, do commonly hire, sometimes it could be a tax agent, it could be a tax advisor to assist. So the cost of managing tax affairs is a deduction of itself. And, a tax agent who prepares a tax return for a client, one thing they need to do is claim as a tax deduction for that client the cost of their own services, right? Okay, moving on to gifts. Now, this is a very interesting one, and I used it in week 1, I think. So with gifts, let's firstly go through when you can get a tax deduction for a gift. The relevant provision is Division 30 of the 97 Act. Under this provision, taxpayers can get a deduction for gifts. It can be money, it can be property, right? Okay, could I ask everyone to pay attention and not have any private conversations? Actually, until that moment, you were being so good, and nearly everyone is, I think, paying attention and trying to follow the lecture, right? Okay, so when can you get a tax deduction for a gift, right? And Division 30 is the relevant provision. Well, you have to be making a gift to what's known in the tax law as a deductible gift recipient. And to get that status of being a deductible gift recipient, the organisation, right? And these are the kinds of organisations that are able to get this status. It is, public institutions, organisations that exist largely for the public benefit. There's a strong public benefit element in terms of the organisations that are able to apply to this taxation office to get deductible gift recipient status. Now, we are able to claim a tax deduction for a gift if it is made to a deductible gift recipient, right? So they've been endorsed by the Commissioner as having that status. And they will advertise to the public that they are deductible gift recipients because they want the donations. And also there are a limited number of entities that are actually mentioned in the Tax Act, right, as being deductible gift recipients. So the universities, all the universities in Australia, including the ANU, are deductible gift recipients. If you make a donation to the ANU, it's tax deductible, right? Public hospitals, non-profit organisations such as charities, right? They would all be registered as deductible gift recipients. So when you donate to them, it's tax deductible to you. Now, I'll ask the same question I asked in week 1, okay? Well, I didn't ask it, I didn't present it as a question in week 1 because it was week 1, but I told you about it. If we didn't have Division 30 of the 97 Act, would we be able to deduct for gifts, right, under Division 8? Kim is saying no. Yeah, no. Because when we make a donation, say you make a donation to the Australian National University, how does that relate, right, say, to the generation of your assessable income, right? When you make a donation to a charity, to a public hospital, how does that relate to your business or the generation of your assessable income? It doesn't. And the reason you donate is because you want to support that organisation, right? So this is an instance where the whole legal basis for deductibility is dependent on Division 30, right? And what's the reason? The government wants to encourage philanthropy, for certain purposes anyway, for certain causes, right? Now, in terms of requirements to get the full deduction, well, look, it must be the case that it is a genuine gift, right, to get the deduction. And so if there is some expectation of a benefit back, then no deduction is possible. So FCT and McPhailey's authority for that, it's a High Court case. So it's 1968. So you can see this provision, right, would have had a different number at that time, has been in the law a while. Now, in that case, a father donated money to a school building fund, and the school was a deductible gift recipient, and he tried to claim a tax deduction, and the court held no, he cannot, because parents that donated to the school building fund got a benefit in the form of a reduction in school fees, right? And it doesn't matter, it's irrelevant that he's donated more compared to any reduction in school fees he gets, right? That doesn't matter. If you're getting any material benefit back, then it's not a true gift for the purpose of the tax law. You're not entitled to claim a deduction under this provision if as a result of claiming a deduction for a gift, you would be put in a tax loss position. Okay. Now, there's an important restriction for businesses. If you are operating a business, right, whether as an individual or as a company, you cannot get a tax deduction for a gift made to a political party. So if you're running a business, you cannot get any tax deduction for a gift made to the Labor Party or the Liberal Party or the National Party or any other party, right? And what's the rationale? You want to have a try? What's the rationale in the law for that? principle. Yep, you're saying personal gender, Tanish? Yeah, yeah, it is. It is. Look, we in Australia, right? The idea in the Constitution, at least, that is that it's supposed to be a democracy, right? We are not supposed to be able to influence politicians through making financial benefits to them. So that's the rationale. Individuals who are not operating a business, right, can get a deduction, but it's very limited, right, in the sense of it's only up to 1,500, right? Yeah, it's pretty limited. Okay, now let's go to the final slide. Okay, so good. Sometimes there's interaction time and time for you to think about these. So now, when I give you little problems to do in class, this is when you can talk to each other. Not a problem. Have a chat, have a discussion with the people around you, right? And it's recommended that you will. So I'm going to give you about 2 or 3 minutes to go through those and to work out whether it's deductible or not, or to some extent. That may be the answer. And you've got the slides, right? Also see whether you can find the provision or a relevant case or a ruling. But if that's too time consuming to do that, then just simply go through with deductible or not, or partly, okay? So maybe 2 or 3 minutes, and during this time you can talk, right? Talk as much as you want. It's really good to see people discussing. Good on you. Keep going. Okay, let's talk about this, right? Okay, so looking for volunteers, right? And if not, I might just ask someone because you have been discussing, which is great. Okay, or you can all shout it out, right? What you think. Okay. So salary expenses of 200,000. This is for Tim. We have to know the context. Okay, so Tim runs his own advertising agency. During the year, he incurred the following expenses. Salary expenses, so what he's paying employees, deductible for him. So you're running a business, right? You employ people, right? So for your business, is salary a deductible expense? Yes, yes, of course, yes.
I have a question.
Yeah.
In that case, if that's the rationale, I wasn't aware of the theory at the moment. So the logic I went by
Yeah.
was, for example, a business has $5 of expenses and $7 of revenue.
Yeah.
Total. And out of those $5, $2 was the share they pay for a salary. Okay, did you follow me?
So $7 of revenue, right? $5 of expenses.
So the total profit's $2, right?
Yeah.
If the salary they spend in those $5 is already $2 itself, so if you deduct salary expenses, the profit will be nil anyway.
Well, look, no, I mean, look, with salary, if I can just talk about, because this is a big cost for business. Look, you can tell me about the details for accounting, because it's a long time since I've done accounting, but I mean, it's an expense for accounting purposes, isn't it? Yeah? Yeah. And in terms of tax, it's no doubt about it that it's an expense, it's a tax deductible expense. It's a very clear cut.
It's just that I agree with you that it's an expense and everything.
Yeah.
Discussing on the part wherein commenting on it, wherein I felt the rules.
A partner,
I'm commenting on the fact that the rules pretty lenient in that manner than in that case. And the rationale is pretty strong because salary is a huge expense, and if you deduct that from profit,
yeah.
it doesn't get as much tax. Like maybe a part of it, maybe some percentage, why the whole thing?
Look, if deducting salaries puts you in a loss position, so be it, right? Yeah, there could be many businesses in Australia, around the world. Okay, let's just talk about Australia, because at least we know the law and accounting that applies to Australia, where paying your employees, paying them salaries puts you in a loss position. That's very common, right, for new businesses in particular. So be it. That means they have carry forward losses. But it's one of the clearest cases, right, where there's no doubt about it that it's a deductible expense. Okay, what about the next one? Salary costs of $10,000 for his daughter who worked with him for 1 week as part of her university training. Pire, very good. It would be just the market value that is deductible, right? Yeah, it's the reasonable amount under section 2635, which you do have in your slides. Now, so $10,000 for 1 week, oh my gosh, part of a university training, it seems way too much. I mean, she's still at university. So it's whatever is considered reasonable. Look, maybe reasonable is $500, right? Something probably in the hundreds is reasonable, or, or not, certainly not $10,000. So whatever is the market value of those services. Now, I told you about that point of symmetry under section 2635, and the specific provision is 2635(4, is that to the extent that the father doesn't get a tax deduction, right? Say it's actually only $500 that is reasonable value, right? In the daughter's hands, then $9,500 is treated as a gift, and she doesn't have to pay tax on it. Only the market value of the services. Right. Now, travel expenses of $3,000 for travel between home and work. Deductible or not? No. But just note that we went through sort of special scenarios right? Exceptions or perhaps different situations, just note all that in the lecture slides where you can get a tax deduction. For instance, a relief school teacher, where travel is an integral part of your job, where you're doing a lot of travel, you're going to different schools, perhaps different schools every day, or even if it was different schools every week, then that's a special case where travel is a fundamental part of the job. In that situation, home to work travel will be deductible. Okay, next one, travel expenses of $1,000 for travel from a client's premises to his home. Deductible or not? There's a specific point was in the lecture slides, and this isn't one of these special cases, and there's a tax ruling. Look, provided it doesn't happen too often, yes, you can. And it's the Commissioner says so in a tax ruling, TR 2017 D6. So we're not going to argue with that if we can get a tax deduction. Yeah. 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 If it's too frequent, I mean, I know this is a bit vague, but this is what the tax ruling is if it's sort of all the time, the nature of the job, and that's a really good example, Pire, that no, right? If it's something that's infrequent, yes. Okay, travel, no, we've done that one. $3,000 on a new suit to impress his clients. No, good. It's conventional clothing, right? No tax deduction, even if you regard it as virtually, even if you privately regard it as a work-related expense, it's not tax deductible. And just note that case of Edwards that we went through is extraordinary. It's a very unusual case of that lady. She was the personal secretary to the wife of the Governor of Queensland. She lived at Government House, and it was very unusual. She was required to, wear formal clothing, several changes in the day, a lot of travel, limited laundry facilities, and in that particular case she got a tax deduction for the abnormal level of the clothing expenditure, right? But very, very unusual case. As a general rule, even for people who work in, accounting firms, law firms, where, you're expected to dress very professionally at least 4 days of the week, right? There's often casual Friday that they have, but no tax deduction. Sorry? The firm? Oh, uniform, yes. Absolutely. Yes, you can get a tax deduction for uniforms. Yes, that you can. Yeah.
There's a thing I want to ask. Whenever these cases happen and the ATO challenges the person, right? Do they get reimbursed for the costs that are incurred?
Yeah. Yes. I think I made that point earlier, maybe a couple of times, but when we were discussing the university student case, Anstis, right? Yeah. What happens is it's not, it wasn't that poor university student, taking the commissioner to the High Court. It was the commissioner wants a point of law clarified, and the understanding is whatever happens, even if the taxpayer loses, the commissioner pays for the costs. Look, that's not a rule or not necessarily every case, but that is common. Okay. Next one is $1,500 on membership of the local sports club where he entertains clients. Deductible or not? Yes, that's right. No, it's not. It's a denied deduction. It's a specific provision, 2645 of the 97 Act. $3,000 in meal expenses on entertaining clients. No. It's denied. It's entertainment expenditure. Okay, very good. Okay, so can you get the capital allowances slides? Okay, so look, to give you an idea of what's really important, right? I mean, I think I think you've pretty much already learned the really fundamental topics for income tax. So it's, you know, residency and source. I think that's absolutely fundamental, right? Then assessable income, right, including capital gains is an important part of that. Deductions, right? Now, could we have everyone paying attention? Okay. So now, when we're getting now to capital allowances, actually these are, in one sense, they are a kind of a deduction. It's just not a deduction all in one go in 1 year, right? So it's very much related to deductions, and in one sense more than related, it's a species of deduction really, but just note it's over time, over a number of years. Right? And so these slides, we're covering some miscellaneous topics. Capital allowances, trading stock, and tax accounting. And it's a case of, yes, you should know the material, but it's not like I'm going to give you a whole question on, you know, I never have, like capital allowances, where, say, it's a 10-mark question and it's just on depreciation. I don't do that, actually. If I test depreciation, it's part of a bigger question where the bigger question tests what I consider is a more fundamental issue. Okay, so, I mean, you know a bit about this already, right? And I think you know from your accounting studies, you know about depreciation. But don't worry, this course doesn't assume any knowledge of accounting. Funny that, even though most of you are doing it. But the only prerequisite is commercial law, right? So when we're talking about capital allowances, the major type of capital allowances is depreciation. And under the tax law, the expression used is decline in value, and it means the same as depreciation, and it's a tax benefit because it's a tax deduction, right? And the depreciation provision or decline in value provision, it's Division 40 of the 97 Act, right? So the basic position, if we are using an asset to generate assessable income, and it is an asset that has a limited effective life, it's not something that's going to last forever, unless it's specifically excluded, and there are some specific exclusions, we can claim a deduction for its decline in value over its effective life, right? So commonly we would claim depreciation deductions for, you know, equipment, right, used in a business. It's common to claim depreciation deductions, like provided they're in use in a business, for it could be, you know, desks or chairs or, you know, it can be computers. Now, you can actually depreciate a building, right? Capital works deductions, right, though, I won't examine you on that, and the specific provision there is Division 43. Okay, so this is the benefit of lectures. Not only do I tell you what I'm likely to examine, and sometimes I will tell you definitely I'm going to examine something, but I also tell you what you don't need to worry about for examination purposes. Now, in terms of the interaction between depreciation rules and capital gains, right? Because, you know, when you sell an asset, right, generally you're making either kind of a profit or a loss, right? Now, if you have been depreciating that asset, then you will recognise a balancing adjustment under depreciation rules, which will be either an assessable income amount or a deduction amount, and it's under the depreciation rules. If you have been depreciating an asset, you don't recognise a CGT event, right? You don't use the capital gains tax regime. Depreciation rules take priority. Okay, now this black hole expenses, it's a sort of an informal expression. I'll go through this quickly, then we're going to look at depreciation, right, in more detail, and then we're going to go through an example. So briefly, and I've mentioned this already, it's very useful. It hasn't been in the law a very long time, right, in terms of how old the tax law is. It's been around since 2001. This provision, right, 4880, and I have mentioned it before, provides a tax deduction over time, over 5 years in fact, for business-related capital expenditure, right? So you know how we said earlier when we were talking about Division 8 and feasibility studies, that feasibility studies, that is expenditure incurred in order to work out whether a proposed new business is viable or not, the general rule is, well, it's no deduction, right, under Division 8. However, you can get some tax relief. You can deduct under 4880, but not all of the costs of the feasibility study in one go. If it's $100,000, not that full $100,000 in 1 year, but you can deduct it $20,000 per year over 5 years. Now, it's over 5 years. It has to be 5 years. That's what the legislation states, right? And it has to be equal over 5 years. Right. So the kinds of things we're talking about, expenses in starting a business and all the related costs, you know, prospectus, legal expenses, etc. Now, this is the one that would cover feasibility studies, expenditure relating to a proposed new business, right? Now, the legislation doesn't use the word feasibility studies. It talks about proposed new business, but that we know that would cover feasibility studies. Expenses in ceasing, that is ending a business, right? Expenses in restructuring, in changing business structures. So very useful to know about this 4880. Now let's go back to depreciation. So earlier that was just an introduction to depreciation. Now let's have a look at it. Now I think those of you that are doing accounting, maybe that's virtually all of you. Yes.
Sorry, go ahead. You were saying something before.
Oh, no, that's okay, because it's basically, I hadn't really started with going through this, yeah.
I'm just asking, is there feasibility studies
Yeah.
that are not allowed, but proposals to start new business and everything in that section you were talking about?
Yeah.
Then how do we discern which ones, how do we come to a conclusion? Like, they're pretty similar in nature, right?
No, hang on, maybe there was some confusion there. Expenditure on a proposed new business, that is a feasibility study, right? Yeah. Yeah, you can get a tax deduction for that, the cost of that, over 5 years, under 4880.
Under 4880?
Yeah.
We don't apply. But, I mean, if in a situation both the sections apply, then feasibility studies are disallowed.
No, it is allowed. No. The distinction is you can't claim under Division 8. See, if you were able to claim under Division 8, it would be a great benefit, because it means when you can deduct under Division 8, it's a different kind of provision. It means you can deduct the whole $100,000 in 1 year. Right? So that's the difference. Under 4880, it's $20,000 per year. Yeah. So it's over time. It's just like, it's capital expenditure. Like we say that capital expenditure is not deductible, right? But what we mean is it's not deductible in one go. It is deductible over time, right? So, I mean, the main one that's relevant here is depreciation, right? So now you don't need to know accounting, but probably a lot of you do. And so that helps you, right? Because you'll probably find this quite easy. But is there anyone that isn't doing accounting? Okay, Kim, don't worry. Yeah, yeah. That's good. Because really there's no assumed knowledge at all, okay? So, and actually because Kim's in my tutorial, look, you already understand depreciation, so it's fine, right? So by depreciation, we're talking about the decline in value of an asset. So what is a depreciating asset? Well, it's got to be an asset where it's got a limited effective life. What's excluded? Land. Land does not have a limited effective life, right? And in fact, it appreciates in value, right? See, actually, with the legislation under 4030, not only does it say that the asset should have a limited effective life, it says that it must be expected that the asset declines, that is, reduces in value over its life, right? So, look, land is definitely out on that basis. Now, trading stock is a specific exclusion, right? Now, but that's because you get something better than depreciation for trading stock. Trading stock is immediately deductible under Division 8, okay? Some intangible assets are excluded. Example, goodwill. Look, most intangible assets are actually not excluded. So intellectual property, trademarks, patents, you can amortize that. Amortization is same as depreciation conceptually, but we use it for intangible assets. So most intangible assets you can actually depreciate. Okay. Now, capital works expenditure, I mentioned that before, buildings and improvements to buildings that you can depreciate. It's either at 4 or 2%, either 4% or 2.5%, depending on when the building was constructed and when the work was done. But as I said before, I'm not going to examine anything about capital works and buildings, okay? Now, who can depreciate? Who can get the benefit of these depreciation deductions? It is the person who is the holder. Okay, who's that? It's generally the owner. But what's the key concept? The holder is the person that has the economic burdens and benefits, the economic benefits and burdens related to the asset. Nearly all of the time that is the legal owner, but there's one special case that you have to add to that. It is people that have get the economic benefits and have the burdens as well relating to the asset, and provided they have the option to purchase the asset, then they are treated as the holder who is able to claim the depreciation deductions. Now, I think now you're familiar with this perhaps with, finance leases, right? So that if under a finance lease, the lessee, if it's a case that they've got the economic benefits, the burdens, plus they have the option to purchase at the end of the contract or at some time during the contract, then they're a holder, they can get depreciation deductions. Okay. So, you can start depreciating from when you've got the asset ready for use under 4060. That's the start time. What are the methods you can use? It's diminishing value or prime cost, right? Okay, so with diminishing value, you're claiming bigger deductions in the earlier years of the asset's life. With prime cost, it's the same amount over the asset's effective life. So prime cost, that's last on the slide, that's quite easy. It's, just assets cost divided by the effective life. Now, with diminishing value, there's two different formulas depending on whether the asset was acquired. So if the asset was acquired before 10th May 2006, it's 150% multiplier. If it was acquired after 10th May 2006, it's 200%. So we'll go through an example and you can see how diminishing value works. And, some of you may be familiar with this, but we're not assuming any knowledge. Okay. So the example will come up in the slide after this. So effective life. What is effective life? It's an estimate. It's always an estimate of how long you think you can use this asset, right? Now, and just to emphasize, right? To be able to depreciate, you must be using this asset to generate income, right? To generate assessable income, or it must be in some way connected, right? So for an individual, right, for an employee, well, an individual who's not running a business, okay? Some individuals run businesses, but most individuals are just employees. It's pretty limited what we can depreciate as employees, right? I mean, the only one that arises with any frequency is where an employee has maybe a computer, it could be a laptop, where it's not a work-provided one, so that they've bought it, but they do some of their work on it. In that case, you can get a depreciation deduction, but you should apportion, right? If some of your use of that computer is for private purposes, then you need to apportion, okay? So in terms of effective life, for assets, you can either use the Commissioner's estimates, which are published in tax rulings, or you can estimate yourself. It's up to you. If you estimate yourself, it should be reasonable, and it's still worthwhile consulting the Commissioner's estimates to ensure that you're not too far off. Actually, the Commissioner is very generous, right? I mean, we say it's generous if it's a lower effective life, because everyone likes benefits, sort of, bigger benefits sooner. So in terms of, I'm quite surprised by this. The Commissioner's estimate of effective life, it's changed, actually, for a laptop is 2 years, right? So I think most people would get more than 2 years out of a laptop, right? The Commissioner's estimate for a desktop is 4 years, right? Now, the Commissioner will have no problem if you want to use a longer effective life. No problem whatsoever, right? The ATO only cares when they think you're trying to get a tax benefit better than what they will allow. Desks, it's 20 years. Chairs, 10 years, right? So if you're interested, look at the appendix of your book. It goes through some pretty common assets and lists the Commissioner's estimate of effective life. Artwork, 100 years. Right? It's interesting, right? I mean, we know that artwork, that you go to a museum, you see art that it could be several hundred years old. But look, it's got to be maintained, right? It's still not something that lasts forever. And the Commission, well, it's 100 years, right? So, yeah. You're saying it wouldn't diminish in value? Fair point. Look, certainly in the case of some art, look, I think it's actually, it's really hard to say. It's really hard to draw any conclusion unless unless it's a case-by-case analysis. Look, it could be with some art it does diminish in value, right? I mean, I think there's some art that we know that because it's been around for hundreds of years that it's probably going to be always valuable in human history. But then there have been fads in art where who knows whether it will have much value at all in the future. But I think it's an area it's really very, very sort of uncertain, the basis, and even it could be quite arbitrary in terms of the Commissioner just saying it's 100 years. You know, probably not really a strong logical basis to it. Okay, so let's get to this example, right? Now, so asset cost, it's what you think, it's the cost of acquisition, and this includes not only what you paid for the asset, but any further costs, these are called second element costs, required to bring the asset to its present condition and location, right? Now, base value, this is relevant for the diminishing value formula, okay? At the start, right, when you acquire the asset, this is the asset's cost. In subsequent years, right, base value is what is defined as opening adjustable value plus second element costs incurred in the current year. Now, when we look at adjustable value, it's defined as asset cost minus decline in value in previous years. Now, decline in value in previous years is what is known as accumulated depreciation, right? And look, even though we've got that fairly sort of long and convoluted explanation of base value, nearly all of the time, what it is, and certainly if I ever ask you anything in an exam to do with depreciation, base value, because I can tell you now, if I put anything in the exam to do with depreciation, I'm not going to put in second element costs, okay? So if we take out the second element costs aspect, then all base value is asset cost minus accumulated depreciation, all right? Okay. And so that's what it is in this example. So look, I'm still using 3 years, okay? I'm using my own estimate of effective life of a laptop. Commissioner will let you have 2 years, right? But Commissioner doesn't care if our estimate of effective life is longer. So you purchase a laptop computer for $1,000. The effective life, you've estimated 3 years. The computer was purchased on 1st July 2016 and is used 100% for work purposes, okay? So that means you don't need to do any apportionment. You can depreciate the whole value of it. So you've got the calculation for prime cost and the calculation for diminishing value. So prime cost it's just asset cost divided by 3 and the same amount, $333 every year. Then diminishing value, well, this was bought after that date in 2006, so it's a 200% multiplier, right, that we're applying. So can you see you get a huge deduction in that first year. So the asset cost times 2/3, right? So how you get that is, well, it's 1,000, right, times 1/3 times 2. That's the multiplier, the 200%. Now, in the next year, the deduction is a lot smaller with diminishing value, right? Because you had a huge deduction in the previous year. So it's the base value in the second year is $333, right? So the base value is $1,000, right? That's the asset cost, minus accumulated depreciation. And the accumulated depreciation is the depreciation from the previous year, which is $666.67, right? So in the third year, there's a tiny deduction of $74 because you have already largely depreciated, right? So over there, no talking when someone else is talking.
Sorry, I just can follow the formula there. Because I'm used to
Yeah.
value as just 1,000 into percentage, then whatever comes into percentage the next year, then whatever comes into percentage, and that goes on, right? I didn't understand the 2/3. I didn't understand.
Okay, yeah, sure. Okay, so think of it like this, right? Think of it as modifying prime cost, right? So so we've got, don't worry about the 365 days, okay? It's going to be 1 anyway. So we've got 1,000, right, times 1/3, do that first, and then times 2, right? Then what that is actually 1,000 times 2/3. So that's what it is. That's what it means by the 200%. So first work it out for, like its prime cost, 1,000 times 1/3, this is for the first year, then times 2, right? Yeah. We can, if it's still unclear, we can go through it later. Okay, so, and then you can see for the third year, it's very tiny. Most of it's been depreciated. So it's 1,000, right, is the asset cost, minus accumulated depreciation. So you've got to minus the 667 from the first year, the 222 from the second year, and the base value is just $111, right? And then it's times by 2/3. So not very much. Okay, so one more slide and we will have a 5-minute break, right? So balancing adjustments. This is an adjustment you do when you sell the asset, if you do, right? It could be with some depreciating assets, they really have no value and you dump it. But if you sell it, well, then you will have a balancing adjustment if you realize something. Now, the phrase termination value is used in the Tax Act. Termination value means the same thing as sale proceeds, you know, what you're paid for the asset. So where termination value is greater than, so that's sale proceeds, where it's greater than adjustable value. Now, adjustable value, read that as book value, right? As the asset cost minus accumulated depreciation. That's the book value. The difference is included in the taxpayer's assessable income. If you want just sort of a quick memory hint for remembering that, think of it like if sale proceeds are greater than the book value of the asset, it's like you're making a profit, right? And if you're making a profit, then it's going into assessable income. Another way of thinking of it is, well, no, I may skip that actually. I don't know whether it'll help you, but see whether, you know, just with some of these rules, you just need sort of a quick way to remember. Now, let's go through the other case. If termination value, that is sale proceeds, are less than adjustable value, that is book value, well, you can think of it as it's like making a loss, and the difference is a deduction for the taxpayer. Right? Okay. Well, what I was going to tell you, now ignore it if it doesn't help, is that, say, in the situation where termination value, that is the sale price, is more than the book value of the asset, right? What's really, and then the law says that difference has to go into your assessable income. What is really happening there, and this is actually the most accurate way to try and understand it, is that the law wants you to make a correction. It is truly an adjustment, because what the law is recognizing, if sale proceeds are greater than your book value, it means you have been depreciating too much, right, in the past. And then it is, therefore, this is an adjustment. This is putting an amount, because depreciation from the past was a tax deduction you claimed. This is putting an amount into assessable income to correct that. And the same logic applies for the other case. But if you don't find that that helps, this isn't important enough that you spend heaps of time trying to understand it, just learn it perhaps the other way. I gave it to you first. Okay, so if a depreciating asset is used partly for a non-taxable purpose, so partly for non-business purposes, right? You have to apportion. So, for example, say the laptop in the previous example, now assume prime cost for this purpose is sold at the end of year one for $500. Right, using prime cost, then the adjustable value, right, that is the book value, is $666, right, and 67 cents, right? So you've sold it for $500, so that is less than the book value. So you're going to be entitled to a deduction, right? And you can get the whole amount, that is $167 approximately as a deduction if it was used entirely for income generating purposes, but you will have to apportion if it's partly for a private purpose. And so in this example of if it's 30% for private purposes, then you can claim a 70% deduction, and that would be $116.67. And actually you'd claim $117 because you don't put cents in the tax return. Okay. So, okay, let's have a 5-minute break, and then we'll come back to do trading stock and a few observations about tax accounting. Hi. Oh, thank you so much. Oh, wonderful. More people here than I thought. Yeah, of course. Thank you. Okay, we might start because it's only a 5-minute break. Okay, good. Right. So now we're going on to another subtopic, trading stock. Right. So this is the same as inventory. So for a business, and we've got to be talking about a business if we're talking about trading stock, the sale of trading stock, that sales revenue and its ordinary income under Section 6.5. For the purchase of trading stock, the business can claim a tax deduction. So I'll just wait for everyone to pay attention. Yeah. Okay. Now, so Division 70 also contains some special rules in relation to trading stock. But in terms of the most fundamental rules, it's pretty straightforward and it's provisions you already know about, right? Sale of trading stock, that's revenue. Assessable income, ordinary income under Section 6.5. Purchase, that's a deduction under 8.1. Now, in terms of the purchase of trading stock and when you can claim a tax deduction, you can claim it as soon as it becomes on hand, right? That is the expression used in the legislation. It becomes on hand when the taxpayer assumes control over it, is both the owner and has physical control over it and has the power to dispose of it. Now, what is the definition of trading stock? It's really wide. It's anything produced or manufactured or acquired that is held for the purpose of manufacture, sale or exchange in the ordinary course of business. Right? So it specifically includes livestock, right? Animals can be trading stock. What is trading stock for a business depends on the nature of the business. So for a land developer, land is trading stock. For a business that manufactures goods and it's got a factory where it manufactures those goods, land is not trading stock. It would be a capital asset. In the St. Hubert's case, that's where the court confirmed that land is trading stock for a land developer, right? So when a land developer buys land, right, if it's treated as trading stock, it means it's a deduction. Even though we're so used to thinking of land as a capital asset, note that it really depends on the nature of the business. So for most taxpayers, yes, that's true, it's a capital asset and you can't deduct it, but not so for a land developer. In the St. Hubert's case, the High Court also confirmed that raw materials and partly finished goods are trading stock for a manufacturer, right? So what that would be really relevant to is for deductions, actually. So you know that purchase of raw materials, that would be a deduction, certainly. And with partly finished goods, that will be relevant to determining really the value of inventory, the value of trading stock for the purpose of the balancing adjustment, the end of year adjustment, which we'll come to. Okay, so under 7035, if you are a business that has trading stock, you have to do an end of year adjustment. Now, this end of year adjustment involves the taxpayer comparing the value of trading stock at the start of the income year with the value of trading stock at the end of the income year. Unless it's exactly the same, which is pretty unlikely, there will be an adjustment amount. And that adjustment is either going to be an assessable income amount, something that the taxpayer puts into assessable income, or it will be a deduction. Now, if the value of the closing stock, right, the value of trading stock at 30 June of an income year, if that is greater then the value of trading stock at the start of the income year, right, in the previous year, 1 July, then that excess is included in the taxpayer's assessable income. It's an assessable income amount. And that's under Section 7035 too. Now, if it's the converse, if it's a case that the value of the trading stock at the start of the income year is more than the value of trading stock at the end of the income year, the difference is a deduction for the taxpayer. What is the purpose of this adjustment? The entire purpose is that at least in this area, certainly not consistent, the tax law, right, on this point, but at least in this area, the tax law is looking for quite a strict matching of a taxpayer's allowable deductions with the revenue to which it relates, right? And actually, the entire purpose of this adjustment is to ensure that the taxpayer at the end of the day gets a deduction for cost of goods sold, right? Not cost of goods purchased, but cost of goods sold. For the period, for the income year, so this is the purpose of the adjustment, to ensure that what is ultimately claimed as a deduction is cost of goods sold. Now, so the background information you need to know, well, that you would know, but keep it in mind now, is that purchases of trading stock, you get a deduction for that, right? So in order to create the situation, and I see Wei nodding, so which is great, right? If some people are already understanding this, that's great. In order to ensure that we've got a tax deduction for simply cost of goods sold, we need an adjustment because we are claiming a deduction of cost of goods purchased, right? So how we get to that position of it's just cost of goods sold is by comparing opening value of inventory with the end value, right? Now, can I tell you that if in a question you are directly given cost of goods sold, right? Say you're told cost of goods sold is $10,000. You do not have to do any adjustment because it's already directly given to you. You only need to do an adjustment if on a set of facts you're told cost of goods purchased, and then you're given values for the opening value of inventory and the closing value of inventory. In that case, you do have to do that adjustment, right? Net effect is still to get to cost of goods sold. That has come up one time, that at least one time, that in 1 year, sometimes I've just given students cost of goods sold in exams. Usually this is not, huge amount of marks attaching to this, but still you want to get as many marks as you can. So sometimes I've just given cost of goods sold. Other times, at least once, I gave cost of goods purchase figure, and then I gave the value of the opening inventory and the closing one. Right. We're going to do an example in a moment, and you can practice this. So under 7045, well, in terms of how you can value the trading stock, you can use cost, right? Probably cost is most common. You can use market selling value, that is what you can obtain for trading stock in the market, or replacement value. How much does it cost you to replace the trading stock? Okay, the rule in 7041, it should seem pretty much like you'd think that would be happening anyway, but the law does explicitly state that the value of trading stock at the start of the year must be the same as the value of trading stock as at the end of the previous year. Now, an example with trading stock. John makes leather shoes. He sells the shoes directly to the public. Through the internet, his accounts provide the information below. What amounts are included in John's assessable income and what are his allowable deductions? What is his end of year adjustment under 7035? Right. Now, can I give you a minute to go through that table, right? So you've got the starting value of trading stock, right? You've got the end value. Can you go through that table and tell me what you would be putting in assessable income, what you would, what are deductions, and the end of year adjustment? Okay. Okay. Can you tell me, well, how about if I just ask it like this? Now, total sales, what are you going to do with that from a tax point of view? What is that? So if I ask you in this table, can you see any assessable income amounts for sales, right? It's assessable income, yeah. Purchases, that is deduction, yep. Then what about the end of year adjustment? How about, actually, I've been lots of answered questions from this side of the room. Let's go to this side of the room. Okay. What's the end of year adjustment? Someone tell me. End of year adjustment. No volunteers from this side of the room? No? How about the middle? 3,000. Thank you so much. Wonderful. 3,000. Okay, now I want to tell you something, right? Now, if you are just happy to learn that, like you compare, like you look at the closing value of trading stock and it's 12,000, right? Because you add up the completed shoes, the partly completed shoes and the leather, and it's 12,000, right? And at the start, it's 9,000. And we can see the difference is 3,000. And because the value at the end is more than the start, it goes into assessable income. Now, you can just learn that as a rule, like, virtually memorize it. And that's fine if you're happy with that. But if you want to understand it, why that should be so, why it makes sense to do that adjustment, if our purpose is that the taxpayer gets a deduction for cost of goods sold, you can think about it like this, right? Now, if you look at our opening value of inventory, do you see that it's $9,000, right? It's $9,000, right? On 1 July, if we add up all those amounts, $9,000, right? Now, what did we buy during the year? $10,000, right? So that's $19,000. So what we had at the start, 9,000, plus what we bought during the year, 10,000, that's 19,000, right? Now, subtract what we have at the end, which is 12,000, right? We have at the end 12,000. We have, gives us 7,000, right? Cost of goods sold of 7,000. Now, by the way, I'm happy to go through this after the lecture for anyone that wants me to, okay? So 7,000 cost of goods sold, okay? Now, let's think about our adjustment. What's happening? Now, our adjustment is we're putting $3,000 into assessable income, right? That's what we said. Okay. Now, keep in mind, we're deducting 10,000, right? So we've got a deduction for 10,000 for the purchases during the year, right? We're adjusting, so think of it, okay, deductions 10,000, our adjustment 3,000, what's happening? 10,000, and we're putting 3,000 into assessable income, we're getting to 7,000, right? It's the effect of the adjustment is to get to cost of goods sold. If that wasn't clear, then happy to go through with you individually after the lecture. Okay, if you don't really care about understanding it, that's okay. You can just learn it. Okay. Right. Now, so that we finish, I mean, we really should finish this material, let's go through this subtopic, tax accounting. Okay, so look, we have talked about, you know, the taxpayer, you know, recognising amounts and, you know, as assessable income, recognising deductions, but what we haven't talked about in any detail yet is timing. When do you recognise an amount as assessable income? When do you recognise that you've actually incurred a deduction? That timing could be very important, right? It affects the computation of your tax liability in a particular year, right? For some, it could be very important for cash flow, because once you complete your tax return, and if you have a tax liability, then you have a certain amount of time to pay it to the tax office. With individuals, a lot of the time we don't have those, right? But it can happen. And with business, well, they have pay-as-you-go installments too, but they are more commonly in the position, at least compared to individuals, of it could be sometimes they owe tax. Now, in terms of the accepted methods for, well, actually, before I was about to skip this this point, but I should make it, right? So in terms of the tax law and the language it uses, it says we recognise income when it's derived, that's the term used. When deductions, it's when it's incurred. But those particular terms are not defined in the tax legislation. So we have to turn to case law and what judges have said. And, well, what the judges have said quite sensibly is that the courts are going to pay very close attention to commercial practice and what businesses are doing. And what is considered reasonable in business, the courts are saying is, as a starting point, it's going to be taken as, well, that's reasonable for the tax law too. So in terms of income and its derivation and when should income be recognised for tax purposes, right, there are two accepted bases, but where the reasonableness of one will depend on the circumstances and the size of the business. So the two accepted methods are the cash basis and the accruals basis. So, and you will be familiar with these concepts from accounting, but we know that in accounting it's accruals that is emphasised. So with the cash basis, it means that income is recognised when cash is actually received. With the accruals basis, income is recognised as derived when it is earned, that is, when the legal entitlement to it arises, for example, when you perform the service, regardless of when it is received. Now, in terms of what is appropriate, it really depends on the nature of the taxpayer. Now, for individuals who are not running a business, right, for individuals, the tax office suggests, and judges have suggested, that the cash basis is appropriate. I think it's entirely appropriate. For individuals, you take individual employees, I mean, without income, I think it makes sense to treat us as having derived that income when it comes into our bank account, when we receive the cash. And it also just makes sense in a practical way because as individuals, and this is true for small businesses too, we really need to manage our cash flow. And we don't want to be treated as having derived income unless we've actually got it in our hands. Now, for small business, well, they could choose cash or accruals, but there's actually an ATO recommendation, and it's noted at page 553 of your book, that the ATO suggests that small business do use the cash basis for the same reasoning as individuals, to help them manage cash flow. Because the thing is, if you recognise yourself as having derived income in circumstances when you haven't received it, just think about the implications. You will be assessed for tax on that, and if you haven't got the cash, right, there could be some serious cash flow implications. With the accruals basis, the position is that that is considered appropriate for large businesses and large professional partnerships. Now, let's have a look at this case, Henderson, right? It's a High Court case, and it deals with this issue of what happens when you change systems, right? When, in this case, when you go from cash to accruals, what are the implications? Because we know under the law, the principle is that big businesses and large professional partnerships should adopt the accruals basis, right, where income is recognised when the service is performed. But what happens when you're growing as a business? It could be appropriate to change from cash to accruals, as did Henderson. What are the tax implications? So in the Henderson's case, you had in the 1960s in Australia an accountancy firm who was growing. Now, it switched from cash to accruals. In the 1963-1964 income year, it was still using the cash basis. Then in the following year, following income year, so that beginning 1 July 1964, it changed to accruals. Now, the commissioner actually refused to accept the change of accounting method, which seems pretty extraordinary that they refused to accept the change. And the commissioner was influenced by the fact that as at the end of the 1963-1964 income year, that is, as at 30 June 1964, there was a large accounts receivable, right? Now, at the end, in that particular year, ending 30 June 1964, the firm was still accounting on a cash basis, and so it had not recognised that accounts receivable as income because it's on a cash basis. Then in the following year, it has switched to accruals. Now in the following year, that is the 1964-1965 income year, when these clients, like these customers who were accounts receivable, they're now paying. They're paying their bills. The cash is coming in, right? But the firm has switched to accruals. Under accruals, the income is recognised when the service is performed, right? Not when the cash is received. So when the money is coming in 1964, 1965, it's not recognising it as income if it related to that accounts receivable as at 30 June 1964, because its position is we're operating under accruals. Now, okay, what did the High Court decide? Can you get this tax benefit? It will be a one-off tax benefit. It's in relation to the year in which you change from cash to accruals, right, in relation to simply that accounts receivable amount owing as at 30 June of the previous income year. In the following year, when the clients pay, is it just going to be tax-free income because you've changed methods? And the argument is when it comes in, well, we're under accruals. We don't recognise it when it comes in. We recognise when we did the service. We did the service last year. But last year we were still operating under the cash basis, where under the cash basis you only recognise it when it's received. Can they get this benefit? Is it too good to be true? Well, it might seem too good to be true, but the High Court said it's not taxable. It's tax-free. It's not ordinary income because they said this is a consequence of the change of method, that they're operating under accruals now, and it's reasonable for them to operate under accruals because they're big. They've got 19 partners and 295 employed staff. Under accruals, you don't recognise it when it comes in. That's not the important moment. It's when the service is performed. But when we look at when the service was performed, it was last year, they were operating under a cash basis. The High Court said this is a one-off tax benefit. Okay, so before we think, oh my goodness, isn't this crazy? Just put it into perspective. It's a one-off benefit for that change year, and it's not relating to all of their income. It's simply relating to the outstanding accounts receivable as at 30 June of that year. So not taxable. May seem extraordinarily good, but that was the outcome. Now, okay, I'm going to go through it in tutes, not lectures, and there'll be a note in your tutorial notes on this, though, in relation to this very thing. Henderson, there's a CGT development, okay? Could be taxable under CGT with what used to be tax-free according to Henderson principles, okay? We'll go through that via the tutorial. Okay, let's keep going because I think we really need to finish. In terms of prepayments and derivation of income, now it was the Arthur Murray case that raised this issue. So here you had a business that was providing dance lessons. Now, it actually charged up front for these dance lessons, right? The clients paid up front, prepaid for, say if they're having 10 dance lessons, they paid at the start. However, the firm in its accounts, it only recognised the income as having been earned when it actually provided the dance lesson. So is that reasonable to do? That even though you've charged the client up front, right, for the dance lessons, if you only recognise it in your accounts as having been earned when you provide the dance lesson, then is it okay for tax purposes to only recognise the income when you provide the lesson? The High Court said, yes, it's reasonable. Even though as a business you've been really quite harsh, I think, in taking all of that money up front, if as a matter of accounting practice you only recognise the income as derived when you provide the service, you can do the same for tax. Okay? That case, it is discussed in your book. It's around page 555. Okay? Now, if there's uncertainty about whether the taxpayer is legally entitled to an amount, then the income will not be regarded as derived, right? So in the BHP case, there was a legal dispute, and it was very unclear as to whether the taxpayer in a particular income was entitled to an amount. Then, you know, there's no derivation of income in that year. Now, a tip for you, there's a lot of detail about that BHP Billiton case in your book. Don't worry about the detail. It's not important to understanding that principle. Okay, now, one more slide. With expenses, it's actually far simpler. An expense, there's one rule which makes sense. An expense is incurred when you come under a legal liability to pay it, and it doesn't matter when actual payment occurs. this is actually, this is pretty useful in all sorts of contexts, right? Say you're going on a trip and it's arguably, or it is, a self-education expense, going on a work-related conference. You say you're not being reimbursed by your employer, okay, so it's a tax deduction for you. Say you pay for the trip, right, on 30th of June. Okay, the trip is only in September, say, of the following year. Okay, you book it 30th June. It's a tax deduction for that year. It's when you incur the liability. Okay, assuming you do incur the liability on that day. Okay, now note provisions, provisions for long service leave, provisions for doubtful debts. Provisions are not deductible, right? They're simply provisions. They're simply estimates of future liabilities. It's only, for instance, when you actually have a bad debt crystallised that you recognise the deduction. Now, with prepaid expenses, right, this is the situation where, say, it could be a lease payment, it could arise in relation to any business expense. Say you pay for it up front, and in terms of the benefit you're getting from that expenditure, you get that benefit over more than a year, right? And it goes over more than 2 income years, right? Or at least 2 income years, more than 1 income year. What is the position? Well, you actually have to prorata across the income years. So if you're paying upfront for, say, a lease of 5 years, then you have to spread that payment, that expense, over 5 years. You can't claim it as a deduction all in one go. Look, having said that, even though that may seem harsh, it's not that common that you prepay expenses in circumstances where the benefits are realised over years or a long period of time. It's not that common at all. Now, and also there are a number of exceptions to this rule. So with amounts less than $1,000, you can always get an immediate deduction even if the benefit to which the $1,000 relates goes across more than 1 income year. With salary or wages, that's an exception. You can claim a full deduction in this income year even if those services to which it relates go over more than 1 income year. Same with insurance premiums, and there are more exceptions at page 564, 565. Look, I will tell you though that if it's not one of those 3 that I mentioned, I will not examine it, right? So that is for your information. Okay, I really thought, what's the time? We only have 1 minute. I thought that we would get to start partnerships, but it's not to be. So anyway, we will next